Hey everyone, and welcome back to the channel. In this video, Luke Gromen and Preston Pysh delve into the critical issues surrounding the U.S. currency problem, examining both inflationary and deflationary pressures. They explore the sustainability of national debt, the role of energy production, and the potential necessity of Bitcoin and stablecoins in the evolving financial landscape.
Let's define the currency problem first, and let's go into that, because I think it's a nice thread to pull on. How bad is the currency problem now?
The currency problem.
Scale from 1 to 10, Luke.
Spinal tap, turn it to 11.
These things go to 11. I was just going to go there, right? It's very bad. It's critical, and it's from two angles. Paradoxically, it's from the inflationary angle and the deflationary angle. The inflationary angle is pretty straightforward, and then we can dig into it. The United States, which is the reserve currency issuer of the world, cannot mathematically sustain its debt unless its growth is above its interest rate. So little g above little r. So as long as nominal GDP growth is above interest rates, the US debt is sustainable. If once upon a time, if G got below R, it was a problem. Now, because our debt to GDP is 122%, if G just gets too close to R, it's not above R enough, we will have a debt spiral. We started to see that last year in the third quarter when the long-term Treasury market crashed 20% in a quarter, as measured by TLT ETF. If that's fine, that's called financial repression. G over R, great. The problem is that the US debt load in nominal terms is $35 trillion. You need a sucker at the card table with a balance sheet that can hold $35 trillion of US Treasuries in aggregate while GDP grows 7, but your bonds only yield 4, 5. There is no sucker at the card table with a balance sheet that big. And so you need negative real interest rates. When there's no economically motivated sucker at the card table that big, you need central banks to do it. That is inflationary. That's the inflationary side of the problem. The deflationary side of the problem is this can be fixed by a productivity miracle, in theory. Our friend Jeff Booth has done tremendous work on this. The Price of Tomorrow, if you haven't read the book, you should absolutely buy it and read it like tomorrow. And it's a brief 120-page book. It lays this out crystal clear. But the point is that if you have a productivity miracle, then you could get out of this in theory. But the problem is the debt and deficit levels, the off-balance sheet liabilities of the reserve currency issuer are so high that if you have a productivity miracle arrive too fast, you're going to drive unemployment up. You drive unemployment up, you're going to drive deficits up, you're going to drive Treasury issuance up, and you're going to break the Treasury market that way. If the productivity miracle arrives too slowly, then we go back to point A about G not being enough above R, inflationary. And so there's really no fix. And I think I think part of the reason Washington is, let me restate that. I know part of the reason that part of Washington is getting interested in Bitcoin, why they're talking about currency problems, is they know there's no fix. They're painted in a corner. And then when you overlay on top all of this dynamic of peak cheap oil that we've talked about many a time, which is we're not running out of oil, we're not running out of copper. However, we are out of the cheap ores of copper. We are out of, just to maintain our level of production of US shale, for example. Currently, U.S. shale production on the EIA report, the decline rate of existing shale wells, I want to say is like 600,000 barrels per day per month. And so it's been a huge success story, has been U.S. shale. And the nature of the geology of U.S. shale is that once you get to be producing, what we're producing now, 8 million, 10 million barrels a day of shale? Who knows? Anyway, the decline rate is, call it maybe 5-6% at the moment. And to be clear, that's not a linear decline rate. The decline rate declines as you stop drilling, right? That's basically Shale is like an after party, and after you win the championship for your football league, you shake up the champagne, you pop the cork, and it goes whoosh. That's the first 3 months of shale production, and then it's nothing, and then there's a long tail to it. You kind of dump the bottle. That's shale, and it produce, decline, long tail, and so the more you layer that on,
very fiat.
It's so when we layer that on relative to our society still consumes a lot of energy. It needs to consume energy to grow GDP, to sustain the unsustainable debt. And 70% of that is still fossil fuels. Big chunks nat gas now. Nat gas is cheap, at least in America. There's some real promise there in terms of what we're doing, nat gas liquids, etc. Punchline though is the biggest 90% of global oil production growth over the last 10 years has been U.S. shale. And you need higher prices. You get shale much below 70, 65 bucks, 60 bucks, oil, or you get WTI oil much below 60 to 70 bucks. You're going to start shutting down shale. And it's going to take you 3, 4, 5 years to get back to prior peak. I know that. That's a fact because it took us 5 years from 2019 to 4 years, 2019 to 2023. To retake 2019 production highs in the United States. So because it takes you a long time to sort of fight back that burn down. So you've got an inflationary side, you got to keep G above R. You've got a deflationary side where you're basically trying to land a 747 on a piano wire of to borrow a phrase from my friend James Lavish is if the productivity gets here too quick. AI, people say, well, Luke, AI could be. Yeah, in theory. But if AI immediately causes white collar employment around the world to go up from 4.1 to 6 or 7, like the China shock did in the manufacturing part of this country, you're done. Your deficit's going to go up, not down. It's going to more than offset the productivity increase.
My comment on the shale piece is so much of it was dependent on the cost of capital being next to nothing, like everybody got accustomed to. And when you look at how a lot of that was constructed, and they're looking at how the sustainment of all that CapEx moving forward, they're using inflation targets of 2% or less leading up to 2020. And the industry is very slow, to bring things back online. It's very capital intensive. And now all of a sudden you're starting to see inflation, and it's like, oh my God, all these numbers and everything that we prepared for and the cost that we thought this was going to be is very difficult to sustain at the levels that the assumptions that they made leading up to COVID effectively. You made the comment about, people in DC are figuring this out. I would tell you proof of that is all the interest in stablecoins. So Paul Ryan, former Speaker of the House, comes out and has these comments, what was this, like 3-4 months ago, about how important it is that we now can find a buyer for U.S. Treasury issuance, especially with where we all expect the issuance to go, which is off the charts. Who's going to buy it all? Luke discussed ad nauseum all the foreign, 22 trillion net.
The net international investment, yeah. Net international investment position in the United States is.
And it's like they can't soak up more of this for where it's going, and it's not linear. This is exponential where the amount of issuance is going to have to go. And so who's going to buy it? Well, we've talked about this many times on these shows, is stable coins are going to be soaking it up. But prior to recording, Danny and I were sitting here and we're talking about how you have a really interesting technological advancement happening on the Fediment side, where and the Lightning side, where Peter, you and I can set up a channel, and now with discrete log contracts, it's all Bitcoin. Let's say you need exposure to Zimbabwe dollars on your side because you live there locally, you have debt or whatever, that you need that type of stability in the local currency, stability, right?
Yeah.
So you want that on your side of the channel. I obviously want the Bitcoin on my side of the channel because I think it's going to outperform that local currency. And so we set up a discrete log contract, which is effectively a derivative of that channel that's just checking the price of the Zimbabwe dollar every 10 minutes. And then the sats are streaming back and forth between our channel. And all of a sudden you have Zimbabwe dollars, and that you don't actually have to back that with anything. It's just streaming the difference all in Bitcoin. And so what does that do if we play this forward? Because I think this is going to take time, 4 years, 8 years before this becomes much more common. But if you have all these local currencies set up in these synthetic stablecoin derivatives in these channels, how does that play out with the Tethers of the world and all these other stablecoin issuers that are buying treasuries to back the issuance of the coins? Because now you have some competition for buyers, which is the issue that the US and Europe and Japan all have for soaking up all this debt that they're hell-bent on issuing. So
that would fall back to the production, right? It's not based on what the currency is, the financialized. It's based on your fundamental production, right? That's a version of what China's doing right now with setting up in terms of, in the BRICS, well, trade in local currency, settle in goods, net settle in physical gold, and setting up Project Enbridge and CBDCs to cut the underlying layer, the underlying dollar layer out entirely. And then it's really
ironic, but it's ironic because for so long we spent time with this kind of existential threat of them shutting down Bitcoin. Certainly in the early days, it felt fragile. It would have been easy pre-2013 for the government to just close down Bitcoin, and they didn't. And then we've gone through a more recent period where Elizabeth Warren and her friends in Congress have attacked Bitcoin, and they've tried to demonize it. They've tried to bring in draconian legislation against it. But we're now in this position where it's like they may realize that actually they need Bitcoin and they need stable coins to maintain the game. I mean, you read the Mark Goodwin and Whitney Webb piece.
Yeah. I
mean, they talked about this Bitcoin dollar system. It's just it's hilarious. And they're almost going to have to usher it in Bitcoin. They're going to give Bitcoin the red carpet,
no doubt,
to maintain the dollar hegemony.
This was a fascinating conversation, filled with insights and valuable lessons about how the U.S. faces a severe currency issue driven by unsustainable debt, energy reliance, and the potential need for cryptocurrency innovations to stabilize the financial system. The three main lessons from this conversation are: 1. Debt sustainability. The U.S. must keep nominal GDP growth above interest rates to avoid a debt spiral, requiring negative real interest rates when traditional market support is insufficient. 2. Energy dependency. Sustaining U.S. shale oil production and overall energy consumption is crucial for economic growth and debt management, but relies on high oil prices and significant capital investment. 3. Cryptocurrency's potential. Emerging financial technologies like Bitcoin and stablecoins could play a crucial role in absorbing increasing Treasury issuance and maintaining economic stability amidst evolving global economic dynamics. So, what do you think about this Bitcoin conversation? Do you agree with Luke and Preston and their arguments? Let us know in the comments section below. If you enjoy this type of content and want to see more, make sure to give this video a like and subscribe to our channel. Until next time, keep learning and keep stacking.